Imagine a world where your money works for you, growing steadily without the roller coaster of market uncertainty. The Little Book of Common Sense Investing reveals the time-tested strategies used by some of the world's most successful investors. Whether you're a beginner or a seasoned pro, let's dive into the principles that can help you build lasting wealth. Investing can feel overwhelming. There's so much jargon, so many options, and the pressure to get it right. And it's easy to think you need to be a financial expert to succeed, and the fear of losing money doesn't help either, especially with all the ups and downs in the market. Plus, fees can eat away at your gains, making you wonder if you're actually making progress. But here's the twist. Investing doesn't have to be complicated. Meet John Bogle, founder of Vanguard, who revolutionized investing with a simple idea: index funds. Instead of trying to pick individual stocks, Bogle recommends investing in low-cost, passively managed index funds that track the market as a whole. They're easy to manage, cost less, and let your money grow over time. The real question: how index fund works. Imagine you're walking through a vast forest and you want to own a piece of every tree, but instead of planting and tending each tree individually, you find a simple way to own them all at once. That's what an index fund does. It's like a basket that holds a little bit of all the important trees, or in the case of investing, a little bit of all the top companies in a market. In the Philippines, that's the PSEI, which includes giants like BDO and SM Investments. In the US, it's the S&P 500, with 500 major players across industries. Investing in a broad market index fund. This means instead of gambling on individual stocks, you invest in a fund that tracks the entire market, spanning everything from giant companies to smaller ones. This gives you instant diversification, which reduces your risk significantly, and it costs far less. No need to worry about picking winners or timing the market. All right, now that you've got your account set up, let's get real about what you should do next. First, don't go chasing shiny objects. If you're looking for the secret sauce or some magic formula, it doesn't exist. The key is low-cost investing. John Bogle was all about this. Paying high fees to fund managers who are actively picking and choosing stocks, that eats into your returns. Sure, a 1% or 2% fee doesn't sound like much, but over decades, that money could have been working for you, compounding, instead of disappearing into someone else's pocket. So stick with an index fund where the fees are low and the market does most of the work. Let your money stay invested longer, because that's where the real growth happens. Second, be in it for the long haul. Bogle couldn't stress this enough. Don't sweat the day-to-day market swings. Markets are like waves, they go up and down. If you try to ride each wave, you'll get knocked around. But if you're just chilling on your board, you'll catch the big wave eventually. Stay invested. Don't chase quick gains or panic sell when things dip. The market has its ups and downs, but if you ride it out over time, it'll go up. Next, simplicity is your best friend. You don't need to be a stock-picking genius or have a PhD in finance to win this game. Forget about trying to find the next big thing or making constant tweaks. The best strategy is the simplest one: buy an index fund and let it grow. The greatest enemy to your success is overthinking or trying to make a perfect plan. Just let the broad market do its thing, set it and forget it. Now stop trying to time the market. The world of investing is full of people who think they can predict the next market crash or the next bull run. Spoiler alert, they can't. Even the pros get it wrong. It's not about predicting the future. It's about being part of it. As Bogle said, time in the market beats timing the market. Stay in, let the market do its thing, and trust that over time, it tends to go up. Another thing, understand the power of compounding. When you invest, you're planting seeds. At first, the growth might be small, but give it time, and those little seeds will turn into a forest. The longer you stay invested, the more your money will grow on top of what it's already earned. It's like a snowball rolling downhill. It picks up speed and size. So the longer you're in it, the bigger it gets. Finally, keep your emotions in check. Don't let fear or greed drive your decisions. When the market drops, it's easy to panic and sell, locking in your losses. When it's soaring, it's tempting to chase the highs, but that can lead you to risky territory. Stick to your plan, stay calm, and don't make decisions based on emotion. Investing is a marathon, not a sprint, and emotional decisions rarely lead to winning outcomes. The final takeaway: with index funds, the world of investing is less about guessing the future and more about letting your money grow with the market. Stay consistent, invest smart, and watch your wealth accumulate steadily. By following John Bogle's principles, you're taking a powerful step towards long-term financial success